Let's start with an email here from Mary Lou, who's in Richmond, BC. It's on the Lululemon, appropriately. What are your thoughts on the company? Of course, the latest headline was that some of these sheer pants are still sheer, and apparently Lulu says if you're too big to wear them, then don't wear them. They're going to be sheer. So anyway, it's all very confusing.
Well, look, I can only look at the lenses that we look at, and what I would start out with is that in the apparel space, this is something that people care about. The apparel stocks in general have been performing really well. If you were to look at a retail ETF like XRT, you know, it's hitting new highs every day. So certainly people are prepared to invest in things that benefit from consumer confidence. Within the space, there's lots of companies that are doing well. Recently, Lulu has had a tougher time because of some of the problems that they faced with the fabric and change up in management. Look, this is a great long-term growth story. I would like to see a quarter under their belt of getting things turned before I put new money to work. I think that there's other spaces. Ultimately, it's in the right neighborhood. If I owned the stock, I'd hold it. I'm not sure I'd race out to buy it today.
Is it still too expensive here, do you think?
It's not that it's too expensive. It will be too expensive if they miss the numbers again. So ultimately, I think I like to see a turn in the numbers when things go a little bit off, and I'd like to see them put a strong quarter up before I'd put money back to work.
Have you held this before?
We have owned it before.
Yeah,
it's been a good holding.
Right. Okay, here's Jim. He's in Whitefish, Ontario, and he's asking about a utility. Go ahead, Jim.
Hi, Mark. David, do you adjust for pullbacks in the market like Fortis lately, or do you just go with a straight stop loss? Thank you.
Right. So let's talk about the pullback in interest sensitives as a whole. Let's keep in mind that each of the last 3 years in the spring, summer, you've had a period where strategists looked for an acceleration in growth, said rotate to cyclicals, move your money away from interest sensitives. They've backed off and then moved on to make new highs. So I think it's too early to say that we have some secular shift in interest rates. It's very possible in a deleveraging that we could have a very low band of interest rates, both for short and long-term rates for some time to come. So I think that you have to be aware of that. Now, within the interest sensitives, I would suggest you want to look for those with the best ability to increase what they're paying us. And the utilities are less that way. They are more bond-like. So, you know, I think that, yes, the bars have moved a little bit. We are in a higher interest rate range. I do think you can pick away at some of the things that pulled back through the month of May and June. I would tend to focus on things that have more dividend growth attached to them and less focused on the utility. So I don't think I'd buy a Fortis here, but I would certainly look at some of the energy infrastructure companies that give you similar characteristics, but with a growth rate in the dividend of like 4 times GDP growth versus in line with GDP growth.
That was my follow-up question, because you've talked about those stocks in the past. You like them, you hold them. Have you tapered any positions at all, or you're just still holding them full weight?
Like in any case, when we see corrective behavior, we always sit up and take note. We always pair a little bit of exposure, you know, and then see how things sit after the fact. What I would say is, like each of the last 3 years, we are seeing money get put back to work in these groups. And there's some that held up better than the others, and those are the ones we tend to focus in.
And we'll probably have a question more about energy infrastructure players later on the show. We'll get deeper into that, talk about the price of oil. Natalie is in Toronto with a question. Hi, Natalie.
Hi, thanks for taking my call.
You're welcome.
Mr. Burrows, my all-time favorite analyst. I never miss a show you're on. I did purchase American Tower when you recommended it a few months back, and it's been going south. I just need to know what you think I should do. Should I continue to hold, or should I let it go? I'll appreciate your answer, and thank you.
Thanks, Natalie.
So American Tower has pulled back to about where it was in March, with pullbacks in REITs really across the board. You know, technically, American Tower looks sound. I talk about looking for dividend growth. The tower companies will have very significant cash flow and dividend growth going forward. I think that, you know, it pulled back to about 70. It's sitting 77. It's already bounced about 10%. We own SBAC, which is another tower company. I have no problem owning these companies. I think that if you can find companies with a good growth rate in the dividend, even in a higher interest rate environment, I don't think we're going, and we can talk about this later, I don't think we're going from 2.5 to 5 on long rates. you know, we've had about a 60% backup in long rates, which is right in line with every cyclical backup in rates going back to 1980. So I think that it's an opportunity to add here.
And there's SBAC, SBA Communications, the other one you mentioned. American Tower back above its 200-day moving average today, so you figure Natalie should just hang in. You don't know where the purchase price is, but just hang in there and stick with it?
Yeah, you know, the fundamental story is intact. The long-term trend is intact. I'm comfortable owning the stock.
Okay, Natalie, thanks for that. Let's talk to Al now. He's in Ottawa. Hi, Al.
Hi, Mark and David. I bought Alaris Royalty Corp about 2 years ago for the distribution, and since then have been more than handsomely rewarded on the capital side. They've just raised their dividend, and they seem to be setting up for a pretty good next year or two. I just value David's opinion on this one. Thank you.
Al, Alaris has just a tremendous business model. Basically, in return for financing, they get a call on the revenue streams of the companies they've financed. It's a very flexible model. It's good for the companies that they finance, and it's a very lucrative business model for them. This is another company that should see continuous dividend increases as it has had over time. And so if you believe that we are in a world where GDP growth may be somewhat muted, you know, yes, the US is better, Europe continues to be sloppy, Asia continues to be sloppy, emerging markets a little bit sloppy, then companies that can have dividend growth well in excess of GDP growth and give you a yield premium over top of what you'd get on something that's risk-free, I think will continue to be very favorable. So I think Alaris has got a great business model. Stock pulled back a little, but I think that I'd be a buyer of a lot of these companies in and around these levels.
And you hold this?
Yes, we do.
You do, Alaris Royalty. Quite a chart on that 5-year. Let's take a break here with David. More questions right after this.